Legendary reliability, excellent resale value. Check out Toyota's amazing lineup of affordable trucks, like the rugged full-size Tundra or off-road ready Tacoma. Visit buyatoyota.com for more. Toyota, let's go places.
Reality radio for a really great future. We're talking real money.
It's Talking Real Money time. Hi, I'm Don McDonald. Tom Cox over there. We're here to help you do something important. Manage your money better. And we're here to stop you from doing something really dangerous. Getting caught up in the emotions of it all. Really, that is the biggest purpose we serve, is to maintain your emotional stability, because we get a little crazy. And we get a little crazy in times of what are perceived to be extremes. And lately, we've been going through periods of the dreaded all-time highs. You know, the market hit all-time highs. And when we hear the market hits all-time highs, we think, I better wait to invest. Should I wait? Yeah, I think I'll wait until the market's more affordable. But that's called timing the market. And I think we've shown you that it doesn't work. But today we're going to try and illustrate it even more simply than we have in the past.
Yeah, it's a fascinating thing that we all believe that recency bias is an issue, but we also think we can see the future in some way based on where things are today. And I think you said this well at Retire Meet one year when somebody asked a question and they said, this has got to, and you said, we don't know what's going to happen 1 second from now, 5 seconds. No idea. But people do have this belief. They do have a tendency, as you said, to think, well, markets are at an all-time high, I should wait. Or conversely, we got all these new tariffs. The future's horrible. Got to get out. That turned out to be a bad decision. I mean, it's one or the other. But Schwab did this. I think this is valuable because the work is not just an aggregate number.
No, it's actually sort
experiences. Yeah, it's fascinating.
It's simple and it's personalized. Now, the problem is it's 2 years old. So this data is not up to date. But I love this scenario. Let's just look at it even more simply than they did it in their article. Let's look at it as 4 different investors. Okay, we have the world's luckiest investor, and she, 20 years ago, put $2,000 in the market at the exact lowest price day in the year and managed to do the same thing every year. Purchased perfect timing. The lowest day every year, put $2,000 into the market for 20 years.
And that might have been April of 2025 this year. Who knows? Something
right,
like
exactly.
Yeah.
You got in at the lowest day every year, put your $2,000 in. Then you have somebody else who just takes their $2,000 and every year, once they get the money, they dollar cost average into the market, very first day of the year, every single time. Then we have our third person who invests her $2,000 every year at the market's peak. At the
awful timing.
Oh, just terrible timing.
And we run into people that say this all the time too. I was so sure this was going to happen, and I knew at the time, this is a bad decision.
Yeah. So now we have 3 people: incredibly lucky, disciplined, and incredibly unlucky. And then the final one, sort of our control, is that guy. You know him. He sits around going, I just don't believe that this is the right time to be in the market.
Well, or they made a move in like 2020, which is now getting the rearview mirror 5 years, because I run into these.
Yeah,
I'm waiting.
This guy, though, in this hypothetical scenario,
I know.
This guy, over 20 years, had his $2,000 a year. He went ahead and put it into treasuries because they're nice and safe, and I'm going to wait for the right time because I know when it feels right. Except this guy didn't even get in at the high. He just didn't get in.
So you had one that perfect timing, one lousy timing, one just I'm going to invest because that's what I do every year, and then one that said, no way, this market is not going to make me money. I get it.
Now, of course, this whole scenario is the S&P 500, okay? Which we don't like. We'd rather see you do internationals, but hey, whatever. So our lucky investor, of course, our lucky investor did the best, right? Turn that 20 or that
$2,000 a year, 20 years,
$48,000 into $173,000. The big winner. Now the average dollar cost averager, of course, didn't do as well, but did pretty well, turning that into $161,000. How about the one who had the worst market timing? $141,000 just because they got into the market. They just got in. That's being in the market, even if you pick the worst time, worked out.
Yep. How about
our T-bill guy
who
never got in?
How much?
$64,000.
Then he can answer the $64,000 question then, I guess. Huh?
Exactly. If you invest for $64,000, you're not going to do as well as if you swing for the fences a little bit more.
And we didn't, by the way, include what inflation has meant to these dollars after 20 years.
No. This is just all...
This is just total return.
Total return on the S&P 500. These are all hypothetical results. Nobody actually did this, but it is illustrative of our basic premise. Discipline may not win, but it doesn't lose the game for you.
Yeah, it doesn't win, but here's what it does. First of all, it's far easier. I mean, the guy that
can you imagine how lucky you'd have to be to pick the best day every year?
You have to spend a lot of time on that too, right? I mean, instead of just money going in. Number two, if you use the money going in every few weeks, as most of us do, and you should, if it's an employer-sponsored plan or whatever it is, that works pretty well too because you get a variety of prices over the years, right? You get the prices in April, you get the prices that are, going to be here now in August.
You're saying you get the highs and you get the lows.
You get the whole thing.
And everything in between.
Exactly. And for most people, it's going to work. And it's easier. And frankly, here's the part that you talk about a lot, which makes sense. It really wrings the emotion out of the whole, because it's just going in the market. You're not going to sit around and say, wait, how could it be this high? COVID happened in 2020. You got the tariffs, all the stuff, the bad news that exists, but you managed to tune that all out. That's what I love about the disciplined approach.
And our third example, that person who got in at the absolute worst time every year. This is the scenario that most people think, that's going to be me. I'm going to get in on the worst day because we make money regularly and we invest it, hopefully regularly. And if we invest it regularly, people are thinking to themselves, I'm certainly going to be putting it in on the worst days. It's going to be me. Well, you're better off putting it in even on the absolute worst days and being in, or you would have been, than being out.
That's the hard part to face. And the other part, frankly, is even when you hear these numbers, the hard for me to hear is, well, sometimes the traders, the people that are trying to game things, do actually end up with more money. But to me, more stress, more time, more energy.
More risk.
More risk, yeah.
More risk.
The disciplined approach works well. And
that's the difference. It's that risk thing that you got to factor that in. I
shared this with one of our advisors today, Sean, bright young guy, CFP, and he read it, and he said one of the things that my takeaway from any of this is, markets go down, and we've mentioned this in podcasts, how often, far more than you think, but rebounds feel like they come more quickly today. They certainly did in 2020 after a sharp downturn, right? They certainly did in 2025, right? April was way down, and now we are back up.
They even did really from that horrible market of 2008. It took less than a year.
I know.
For it to recover, and the recovery was hidden. It wasn't, there's the old argument about it, you miss the 10 best days, you miss the bulk of the return in the market. Well, in 2008, some of the biggest up days occurred in the depths of the downturn.
Exactly. Yeah, that fall was huge. So again, back to the approach that we would recommend for, yes, still global diversification. Yes, you're still paying attention to costs. Yes, you're trying to be tax efficient. But here's the fourth kind of golden rule for me when it comes to investing. Discipline is everything, because it doesn't, to have a regular contribution schedule does not allow you to say, oh, well, it's different this time, or all the reasons you don't want to invest, because they always exist. They're out there today, even though the market's at, basically new record highs, right? All those negative, there's wars, there's tariffs, there's new tax bills, there's always those things. But the disciplined approach removes you from that entire equation. That's what I love about it.
Yeah, and there's even a bigger analogy that kind of goes with that. It's when you have discipline in your investing, it's like having discipline in your life. I think human beings have pretty much proven that a rules-based system beats anarchy, for example. I mean, that's why we created rules and laws and things, because everybody for themselves turns out to be a bad situation.
Wait, so you're saying having rules like to live by and stuff is a good thing?
It's kind of a good thing. And
I'm trying to share this at home, but they don't buy into it.
It's a good thing when it comes to your investing.
Oh, okay.
Because it takes away the emotional anarchistic
that's fair.
tendencies of human beings. We're going to do dumb, selfish, emotional things if we don't have rules.
I love it.
Life and money.
Exactly. All right. So
bigger
we're going to get
picture.
some questions. Yeah, I think that's spot on. We've got
and our biggest rule here on Talking Real Money is we try to answer all of your questions.
We're whittling them down. We still have a lot, and keep them coming. We love them. Please send them. And this is a comment. Just got this, but I thought I'd share it now, because it's a nice comment about me. I guess that's why. One of my rules is keep saying nice things about Tom.
I'll be muting.
Zach writes us from Henry, Illinois. Just wanted to shout out a thank you to Tom for calling me today about my question I asked about a month ago. Now, Zach sent us a fairly complicated question about taxes, how much to withhold, et cetera. I talked to you, I think, about this a couple of days ago, Don, and it wasn't one we
can't do that on the show.
No, we can't. First of all, we try not to do taxes anyway, because we're going to mess it up. Mm-hmm. And part two, frankly, is just more complex. But he said, I was at work, wasn't able to answer, but he left me a nice voicemail answering what was needed to assist me. I appreciate the advice. I'm going to take action to make the change advised. I love that. Right? Because I've run into people where we've told them to do things, and then 10 years later I go, well, what happened? Oh, well, I didn't do it.
I didn't believe you.
I really love the show. It was great to receive advice from a phone call from the dynamic duo. That's why I read it, because he mentioned you as well.
Yeah, but
and here's my
I'm
favorite
not as
line.
nice as you. I'm not doing that.
Keep up the hard work, and thanks for always talking real money. I thought that was just a nice comment. Thank you, Zach.
Should have saved that one for the end of the show.
Oh, that would have been
because you could have ended the podcast with that. It would have been a powerful.
But we may
ending.
still get to that. We'll see.
No, we're not doing it again.
Okay. This comes from Long in St. Joe, Michigan. Hi, Tom and Don. Love the show. 35-year-old CPA. I think that's certified public accountant, right? Mm-hmm. Yeah. Okay. Working the Big Four life. What's the Big Four?
One of the Big Four accounting firms?
Yeah, okay. Mm-hmm. I bounced around a few firms starting to accept...
It used to be like Big Eight or something, and that's Big Four?
Yeah, like the football conferences, fewer and fewer every day. I bounced around a few firms. I'm starting to accept that this isn't my passion. What really energizes me is talking to people about what I've learned from you guys, Paul Merriman, Clark Howard, and like. I'm pretty well networked locally, but that means with the Ed Joneses, the LPLs, and the MLs, and I just don't think I could try to work for one of those places if I can't advise people in investing how I would invest. Hey, good for you for having some...
Thanks for having some conscience, a rules-based approach to
I love
this.
that. The question is there any way to leverage one of those firms to teach and advise like what I've been taught? Or how else can I turn into a career that actually makes me excited to get up every day? In other words, how do I become a financial advisor? This is so. By the way,
I love this and hate it at the same time.
I had 2 conversations last week with people 15 years older than Long, and had to tell them that basically for them, you probably got to go hang your own shingle. It's just really hard to find somebody who will take you on as kind of an associate advisor.
To hang your own shingle, you got to have some deep
pockets. Well, he says he has some networks. He has some.
You got to have some deep pockets, though, because the initial expenses, all of the regulatory filings and the like, it's an expensive proposition, as we can absolutely attest.
We've been there. But it's getting easier to do. There's firms now where you can
technology.
Way better. So, okay.
Yeah, but this is the most important part, though.
Please.
To me, the number one, it is not your financial skills that make you a great financial advisor.
Nope.
That's not it. That's what most people think it is. They tend to be data-driven.
No, you're not picking stocks. You're not.
And
doing
I'm sorry,
but
it's the right brain and it's the people skills that make this effective, that make it work.
Well,
now you can either develop those people skills on your own, and the best way to do that is generally by part-time. Go sell something.
Because then
get
you
a
learn
sales
human
job.
nature. Yeah. We used to call it bedside manner, I think, how well you get along with people. Yeah, I think that's fair. But if I were you, here are a couple things I would do right off the bat. I would go get my Series 65 tomorrow. It's a pretty low bar to entry. And then if you do start to look around for a job, you at least have a credential, right? Number two, I would not go to the Ed Joneses, LPLs, and MLs, because I think what they're going to tell you is, here's the phone book, here's your list of family and friends. Start selling them stuff. We ran into this recently with a guy who was a listener. He went to work for another large custodian, and they told him, you got to sell X amount of this product. Now, he told them no.
Wait, did that come as a shocking revelation?
I think to him it did, because he thought, well, I'll go in there and I'll do what you guys talk about doing.
No, you can't do that with them.
I know, but that's the problem. You can't get a little pregnant here long. That's the issue.
Plus, here's the thing. It's a great training ground. I have to admit, it's a great training ground because of the people skills you have to develop.
Absolutely.
The sales skills.
Yep.
However, what it requires is that either you be too stupid and naive going in to realize what you're doing, or you have to sort of shelve your belief system.
At least for a time.
Yeah,
I wouldn't take that route. Here's what I would do.
Today,
No.
I did it. Okay, I did it in my 20s, but I have the naive exemption.
You're under 30, you make mistakes.
I was a dummy.
Oh, maybe under 40.
And greedy.
Okay.
And dumb.
But here's what I would do. I would get my 65, and then I would go to dimensional.com.
Yeah,
and
DFAU. Dimensional.com. That's right.
I would go in there and I would type in, because I think they still have an advisor search for various areas. I would look up those advisors and I start calling them. Saying, here's who I am. I'm a CPA, so I have some financial knowledge.
Yeah.
I'm interested in the business. I have a 65. Can I come in and talk to you? I just want to talk to you. I'm not looking for a job. I just want to know about the industry. That'd be a place to start.
I would modify it a little bit. I would find, as a matter of fact, I think one of the perfect places to train in people skills would be like working the floor of an Apple store or a Best Buy.
It had to be Apple, didn't it?
Oh, Apple, because Apple
Couldn't it
has
be Tesla?
Apple has scruples.
Oh, God. Okay.
And the other thing I would probably do, I would get the 65 and I would start studying for the CFP.
Yeah, I think you could. I thought about adding it, but I want to make it easy. Yeah.
No. I think you really
you show a level of interest. Yeah.
Right. You can even say I'm just beginning my studies for a CFP. I have a problem with the 65 is, don't you have to have somebody, or do they change the rules?
Not anymore. You can go get one.
You don't have to have a sponsor anymore.
Nope.
Oh, because when we did it, we had to have a sponsor.
Exactly.
Back in the old days.
By the way, I just talked to a gentleman who's a little older than Long, who has a 65 and a CFP, and has talked to a bunch of major firms, and they told him, that's great, really great. No.
Because the one thing that makes these firms sit up and take notice is the ability to sell.
Yeah, I agree.
It's the number one thing they're looking for.
I told him to start his own deal, build a client base, because that's the other thing. If you walk in the door and say, look, I've got XYZ already signed up, then they might say, oh, you can sell. You could bring in clients. So not an easy road, Long, but if that's your passion, my suggestion would be at 35, do it and do it now.
Yep,
Don't
pursue
wait.
it.
Yep.
Pursue it, but...
And you and I can say from personal experience, when we left our other firm, which I didn't want to leave. I don't think you wanted to leave. We had good jobs.
No, it
there.
was great. It was nice.
We enjoyed it. But
Yeah.
having that blow up the way it did, all well and fine.
Worked out.
Starting out this one and doing this together, best thing that ever happened to me. And it was stressful. It was difficult. I can remember those years. Not fun, but it worked.
You're always wondering if it's going to work.
I know.
But not everybody, you and I, to some extent, have an entrepreneurial bent.
Yeah, that's true.
Lon may not. It's a different kind of mindset.
It is.
So, but getting the job is hard. I really, truly think the one credential that has always saved me throughout my entire life has been my sales skills.
Yeah, I agree.
That has served
which you
me
don't
well.
want to use.
No, I hate using
I
them.
know you don't. You're not. That's
But
not who
I'm
you
good
are.
at it. I just
know.
hate it.
I know. So,
Okay.
your wife, on the other hand,
Oh my God!
really good, and
she's incredible. Anybody
know.
want an older woman to sell stuff?
I'm going to let
Hire
you say older
Debbie.
woman, not elderly.
Well, because
but
she's
older.
she's over 65. So
All right, leave it at that.
I'm not allowed to say the number, but she's over.
This comes from Paulsbo, Washington.
Is
Question.
that named after Paul Merriman?
No. Paulsbo, P-O-U.
Oh,
Good morning. I'm a federal employee eligible to retire in 2 years. Have $600,000 in TSP, not only retirement income source. Retired veteran, FERS, that's a federal retirement program. Social Security, rental property, and $750,000 in inherited IRA. What are you just writing to brag or something?
Yeah.
Recently attended
Triple dipper coming up
recently
here.
attended a FIBA workshop, FEBA, on how to maximize TSP for retirement. FIBA has fiduciary advisors, and they only work with federal employees. I've been talking to an advisor. FIBA process is to provide the top 3 items which fit your stated need based on modern portfolio theory. They're currently recommending moving 70% of my TSP into an FIA.
What?
That can't be fiduciary by Fidelity and Guarantee nationwide or North America.
Oh, these guys are really tricky. I don't know FIBA, but
The following sounds too good to be true. FIA by F&G is offering a 10% match for the amount transferred, guaranteed, no loss. Can take up to 10% annually if annuity not taken. Come on.
Okay, FIBA is
they're running around talking to people. Yeah,
they claim that they're working on behalf of federal employees, but here's the reality. You read right at the very top of their page. We are not affiliated with the TSP, Thrift Savings Plan, et cetera, or any U.S. government agency or uniformed military service. What they are doing is they're trying to create an affinity cell. And by the way, their principles are, they call themselves FRCs. They've taken some sort of fiduciary certification, which is to me, it's just
that doesn't matter. It's how you're registered that matters. It matters not what you say about yourself.
This whole thing, I am looking up their registration.
But what FIA? That's some sort of an annuity product, I'm imagining.
That's a fixed indexed annuity. It's an indexed annuity.
I thought maybe it was something different here.
No, it's an EIA, FIA. It's an indexed annuity. It is, in my opinion, the most evil pseudo investment sold in America today.
But even saying that, he's a retired veteran. He's got FERS, got Social Security, rental. You already have a lot of annuities. They're going to pay you regularly. Why would you want another one? Why would you even want to do that?
Well,
that makes no sense to me.
These guys, to me, let me just look them up and see if they're an RIA. Federal.
They claim to have fiduciary advisors.
Yeah, well, that's what we're going to find out right now. Benefits. I'm looking it up at advisorinfo.sec.gov, where you all can look. No, they are not an RIA.
Not even duly registered.
No, they're not even. In fact, it strikes me FSC designation. I want to know what that is. They call themselves a fiduciary.
That's a weekend study course of some kind, and you take a test on Monday, and guess what?
Yeah,
now you got a new designation.
There's a certain. They're not. No, let's see. FSC fiduciary standard. I don't know what that is. There's the CFF, which is, in my opinion, worthless.
There's other fiduciary designations. But again, to me, it only matters how you're registered, because that's going to say whether or not you have to put your client's interest ahead of your own.
They're not registered.
Okay.
At least not under that name, not under Federal Employee Benefit Advisors. And they have nothing on their website that says anything about being registered with the SEC, being part of FINRA. And by the way, if they were, those things would be required.
Yes, they would.
Somewhere on their website. So therefore, my best guess is these are what we believe and feel very strongly are kind of lying slime balls.
Yeah, okay. But going back, I don't think you need an annuity of any kind, number one. Number two, in your last sentence in your note said, really sounds too good to be true. Yeah, because really it is. And the real rate of return on the fixed, we've done this ad nauseum. It's not a product that we would recommend that you use.
It's high commission.
Yeah, big.
Which company were they using?
Well, it says Fidelity and Guarantee. I don't even know who that is.
Hold on, let me.
Nationwide or North America.
I want to look up their commissions.
Fidelity and Guarantee and ampersand Guarantee.
On Fidelity and Guarantee, that's a fixed indexed annuity.
Yes. Well, I was hoping it was something else when you mentioned it, but
Fidelity and Guarantee fixed indexed annuity. Let's see. The upfront commissions, it appears, run from, let's see, it looks like 9 to almost 11%.
So do the math. 70% of 600,000 is 420,000. So if it's 9% of 420,000, well, 10% would be 42. So you could just say 35,000 for an afternoon of work. That's pretty big incentive to sell you into this product.
Yeah, these guys, this is, and the reason I feel very confident I can call them a little, one, lying, they're not true fiduciaries. That's just a lie. They're fake fiduciaries. They have no legal requirement to act in your best interest. Therefore, they're just claiming to be fiduciaries. They took some course, which was probably a pass-fail thing and a big fat check, but I'm just guessing.
Yeah. And again, I think the registration's important. I think if you find somebody who's selling something where a commission, you should not be working with them. That creates a clear conflict of interest. So
yeah, they have a radio show on WTOP in
they do.
Washington.
Big station.
And they're on, they're paying, and they're on FNN, which was an old competitor to Business Radio Network.
Yeah. I didn't know that was still around.
I didn't either.
Wow. And guess why they can afford all that? Because they got $40,000 commission on one sale. Boom. That pays for a lot of time. So that's not a direction we think you should head. And you should keep the liquidity in these other accounts, because the other stuff is a regular annuity. You have that income. So I wouldn't make that choice.
I just dislike people like this.
All right. If you want some help,
I'm
just got somebody who wrote me right now while we were doing the show, who says he wants to review a situation.
They're on the Federal News Network, not the Financial News Network.
Oh, Federal News. Of course, that makes more sense. If you'd like to get a little bit of a look at your portfolio, your situation, I take meetings. Other advisors do. You simply go to talkingrealmoney.com and click on Meet an Advisor.
And our advisors are actual fiduciaries.
We actually sit down with. I just had a 38-year-old call me yesterday, who's a regular podcast
they're
guy.
Fiduciary.
They're 100% fiduciary.
Required
100%.
by law to act as a fiduciary, to disclose any conflicts of interest. Here's how you know these guys aren't fiduciaries. They don't disclose commissions.
Tell you
that is a conflict of interest.
Yep.
If you collect a commission, that is a conflict of interest that is, according to law, disclosable if you are claiming to act as a fiduciary. I'm still mad at these guys.
Well,
I'm
because
sorry.
They do it in an infinity situation, like, hey, we're your brothers. We're right here with
it.
Yeah.
I hate it. I hate it. I hate it.
All right. So I told you how you can get one-on-one help. If you want to ask a question, here's how you do that. Dawn, here's how you ask a question.
You go to talkingrealmoney.com. There you go.
And click on,
I don't know, contact us.
okay.
I think. Yeah.
And then you can do it recorded. You can do it typed.
I'm still mad. I'm
and
sorry. I can't concentrate
you can't
anymore.
finish the show.
I can't focus.
And you can also be part of our Saturday live show. That's noon Pacific, 3 Eastern. And you can call 855 something. I forget the number.
935 Tom.
You think I know this by now, but I got a lot of numbers.
Tom, we've had that phone number since 2010.
Feels longer than that.
But you still don't remember.
I know.
855-935. And by the way, it's 855-935, and then just say talk.
Okay.
T-A-L-K.
I could have remembered that. Yeah,
Okay.
I could have got that. So,
8255.
the thing is, as our friend Zach told me earlier, it doesn't matter what day of the week it is. It doesn't matter what year it is. We're always talking real money.
You used it.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.